Okay, so we are supposed to start with basis risk, right? We have covered all these topics: base asset, terms asset, everything, all this stuff you already know. Okay, we've done hedge transactions. Now we are supposed to go on a basis risk. We've already covered, we haven't followed this exact same sequence. We've covered types of hedging programs, we are actually working on decision problems.
Yes.
We haven't finished all the decision problems, right? That's where we were. Okay, so let's go to this and see. Right. So we were at, I think we were basically showing where we stopped last was, where we were showing you why the futures, this is just a listing of decision problems, and then we are talking about our actual solutions and discussions with respect to these decision problems as they apply to the management of a passive risk book, right? So here we were talking, I think where we stopped was, we showed you why, we established why when you're talking about this buy-sell decision, there's another decision, sub-decision within that. That is, what instrument should you use? Okay, I mean, depending on the instrument that you're using, which is a separate decision problem, that in the case of futures, okay, leaving aside the other instruments, in the case of futures, the decision with respect, there's an additional decision problem with respect to expiry, because what is the expiry of the futures contract? Because as you know that their futures contracts have multiple expiration dates, that much you know already. If you just look at crude oil futures, you've seen that they have multiple expiration dates. So the question of buying or selling a futures contract will immediately lead, once you solve the decision to buy or sell, you will obviously have to also deal with the decision with respect to which contract month are you going to buy or sell, right? Is that clear to everyone? So that decision remains. Yeah, as you can see here, many different months that are quoted for futures contracts. So which month are you going to sell or buy? So that's the decision, and we showed you why that decision is an active decision, okay, not a passive decision. They're not there. They're not to be found. Okay, fine. No worries. You told someone else. Okay, all right. Okay. So is that point? Is everyone clear about where we were? We showed you why we say that the decision with respect, because remember what we are discussing here in this module, we are discussing with respect to each of the decision problems which you're already familiar with. We are discussing when you start applying them to the context of a passive risk book, which of the decisions get automatically solved and which of the decisions have to be actively solved by the hedging team. Is that clear? You understood? That's where we are, right? So in the case of this, in the case of a passive risk book, you saw that the buy-sell decision is automatically solved. You remember that?
Yes.
Yes, because in the case of a passive risk book, you already have underlying positions, right? You already have a bunch of underlying positions. So your buy-sell, if your underlying position is long, when you're managing a passive risk book, when you're running a hedge portfolio, you already know that if your underlying position is long, the side of the market that you're on is, you're always looking to sell because your underlying position is wrong. Remember, and because in hedging the philosophy is to reduce risk. So the moment your underlying position is long, so we're just doing a little bit of a recap. I think some of you are still not clear from the expressions that I'm looking at, that in the case of managing a hedge book, okay, a hedge portfolio, the buy-sell decision problem is automatically solved depending on which way your underlying position is. The decision will always, if your underlying position is long, your buy-sell is always decided as sell, okay, automatically solved. But certain sub-problems within the buy-sell, which is what we were looking at here. Within the buy-sell, we have some sub-problems depending on the kind of instrument that you have chosen on your previous decision problem. Okay, in the solution to the previous decision problem, you may be dealing, say for instance, if you're dealing with futures, you will have a problem of expiry date, which expiry date to choose. That decision problem is actively solved. Okay, why? Because it allows for the possibility, I think some of this might have been covered in the post-class discussion with Tarun. Okay, some of it might have been clarified further. So remember that you have to watch the entire video, right? So not just what is there in the class. So if somebody comes and asks a question and I answer that question and that's captured in the video, that's part of your syllabus as well. Okay, so the reason we said that is because of this. Where are we with magma? I think this is where we will put our futures calculations. In fact, Tarun pointed out a mistake I had made in the formula. Yeah, ठीक है अभी. So right. Okay. All right. So remember we had discussed the stack and roll. Please go back and find that calculation. Where is that calculation? You need to find that. Okay, I know where it is. I think we did that in the yeah, we did this here. Okay, remember? So the mistake that Tarun pointed out at the end of the class is that obviously you have to take the I mean you can't fix the reference here. It has to be on a cumulative basis, right? So what happens is, if you're following a stack and roll system for hedging, okay, this is important to understand for futures hedging with futures contracts, because it's a very common technique. So stack and roll is used when you have a whole bunch of exposures, okay, running right down the future strip. You've got a whole bunch of exposures running several months out, and we discussed the case of Ryanair hedging jet fuel for 5 years. Okay, so you may not have adequate liquidity. As you can see here, first 2 months is much more liquid. These are the volume numbers. First 2 months are much more liquid than 4 months, but sometimes you'll get liquidity here as well. So in case you have a problem of liquidity in the far months, you would stack all your exposures, which is what we showed you here. And so the expression stack and roll comes from the fact that if you have exposures all the way here in different months, everyone's following, an airline is planning to operate for the next 5 years. So every month they're going to be buying, or every quarter they'll be buying some jet fuel. They know how much they have to buy. Typically, I mean, they can make some reasonable assumption based on normal volumes. Okay, so typically you would be hedging core volumes. So this much volume you know you're going to have. So you hedge all that. You can project your requirements, and you want to lock in, because you'll actually be buying when you're conducting the business. If you don't do any hedging, the way you normally buy is you would typically buy on a spot basis. That this month we need this much, so you would buy this much crude oil. You will contract to buy this much crude oil. You would be buying very close to spot on a spot basis. But if you are looking at spot, say 3 years from now, who knows what the spot price is going to be? It could be a lot higher, right? But you will actually be buying on a spot basis. So what the hedging team does is basically it locks in the price by running a hedge portfolio. Even though when you actually buy that jet fuel, you'll buy it 3 years later on a spot basis, right? And so that price could be anything. But if you can lock into the futures price and buy it now, buy futures right now, you are essentially locked in. Remember the other principle that we established, that when you do a transaction, when you do a hedge transaction, the price at which you do the hedge transaction, that locks in the value of the underlying position at that price. Remember that? We saw that transaction. We discussed that the other day, right? We put up a crude oil chart here, and then we demonstrated that. Please go back and revise that. These are all general principles that you can use when you're trading actively, which you don't want to reinvent the wheel all the time or go through the entire logic, but you should know why it works. Okay, so the general principle is that when you are hedging at a particular, whatever your hedging rate is, that is a rate that you have locked in for your inventory or whatever else, your purchases, whatever you're buying, right? So please make sure you understand that principle. Okay, so you can see this big jump in the oil price. You followed the news. The US has taken out a top Iranian commander. It's a very, very big figure actually. It's like taking out the head of the ISI. So it's a very, very this guy was very instrumental in Iraq and other parts of the Middle East. So you can see that this particular, from a technical point of view, you can see what is the significance of this move. This previous high has been broken. Can you see that? 16 September 2019. That high has been broken. So from a technical point of view also, this is so you should always, when you're looking at markets, you should look at all these aspects. Okay, so if we assume, we're not really sure whether this is the low or this is the low, it's not very clear. But if you assume that this is actually lower than this, okay, then you have a low here, you have a high here, You have a low here. This low is higher than this low. Remember that? So when you see markets, watch markets, and the advantage of looking at charts is this is all objective information. All this information 100% objective. So you can see here that you've got two lows, one higher low, okay, second low higher than the first low, and you've also now got, until now you didn't have it, but just now you've got this move, okay, just overnight, and you've got this new high which is higher than this high. Are you fine? Are you following? So you got two lows. One is higher than the second, one is higher than the first, and then you've got two highs. The second high is higher than the first. So you've got the establishment of an uptrend. Are you able to follow this? Now you can say you have higher highs because you have two highs with the second higher than the first. So this is a trick that you can use to at least assess the state of the market. At least you can see over this period an uptrend has developed, and that is an objective assessment because you have got higher lows and you've got higher highs. Until now you didn't have, until say 5 days ago you didn't have the higher high, but now you have a higher high, so you've got this uptrend developing. Okay, so when you look at markets, use this kind of logic as well to assess what is happening from a technical point of view in the market. So if somebody is very bearish at this point of time, well, they could be right, but you have to assess that as a very low probability event because you've just had the establishment of an uptrend from a technical perspective, right? So you have to watch it from every perspective, not just fundamentals but technicals as well.
Sir?
Yeah.
You are not observing that the last uptrend that will bring back, the uptrend that was caused by the oil strike.
This, we are talking about this one?
Yes.
Yeah. So what are you saying? What am I not doing?
Such uptrends are very rare. So we cannot actually rely on this.
No. There's nothing. If you are looking at the market from a technical perspective, okay, the fact is that the price moved. Because if you remember, the price moved, it did shoot up after the Iranians struck the Saudi oil facility, okay? And then at the same time, if you remember, after that, it actually went back down below the point where it was when the attack came. So all price action is, as long as it's validated as a proper price action. Sometimes you get spikes and bad data in the feed, which is quite rare these days. But if the price is validated as a proper traded price, okay, if the market has traded at that price, that is valid. That is no less valid than any other trade, and that's not to be invalidated by what caused the price movement. We are not really concerned, as from a technical perspective, we are not concerned with what causes the price movement. We are only concerned with whether the market actually traded at that price or not, whether transactions took place at that price or not. That's all. So from a technical perspective, we don't really care. Remember, technicians don't care about why the market is moving in this way. The point is that the market has moved and it has traded at that price. Okay, because remember that always the other thing that you'll see, which is what makes fundamental analysis quite difficult in many situations, is that the market will always not always going to react in the same way to the same type of positive or negative fundamental news. Right? You would have noticed this in stocks. You will find when the stock has great earnings in a particular quarter, the market will sometimes react well to will bid the stock up on good earnings. But the same stock, next quarter's earnings, they may also be very good earnings, beating expectations, but the stock might actually decline because they will now focus on the outlook. Well, the earnings are great, but the outlook is poor. You know, the companies give guidance, right? Companies give guidance that how's our next quarter looking and next few quarters looking. So the market does not focus consistently on the same set of fundamentals. That is essentially what makes fundamental analysis very difficult to practice. Okay, not that technicals are easy, but technicals do not rely on all these kind of inferences. Okay, in the case of fundamentals, you are relying on inferences that the market will behave rationally. That if the earnings are great, then the market will buy the stock. But it's not always the case, because then suddenly the market goes into some other mood and starts focusing on, well, the earnings are good, but the guidance is bad. Okay, so so you don't know what the market is actually going to focus on from quarter to quarter, or even from day to day. Right? So as you can see here itself, you can see when the news came, it shot up, but then without any real change in the news, and then it went back all the way down. right? Because they were looking at other factors like supply, oversupply, and all that stuff, right? So therefore, that's the problem. So in fundamental, this is where you can see once again the difference between fundamentals and technicals. In fundamentals, we rely on the market to react in a reasonable way. That if the earnings are great, then the stock should be bought. But the market doesn't always react in that reliable way. Whereas in technicals, you don't rely on all these kinds of movements. You don't rely on the market reacting in a particular way to news. You are just looking at patterns. You're just looking at patterns. Okay, all you're saying as a technical player, what you will say here, obviously, is that this is now the development of an uptrend. So if you're operating a breakout kind of system, like the Donchian breakout system, okay, or that's a specific type of a breakout system. If you're operating that kind of a system, you will essentially be buying here. Okay, and you're not really concerned about whether this was based on some, flimsy information or not. The point is that the market traded there. So this is also an important thing to understand the difference between the Are you getting the feeling of what? Are you getting a feel for what I'm talking about? These are very important ideas, because you need to understand later on when you go into the market on your own, you need to evolve a style for yourself. You'll find that many people say we use both technicals and fundamentals. There's actually a logical problem with that. But for your own sake, you should also be saying that, because that's the politically correct thing to say. Okay, I've taught you that. But deep in your own mind, you have to be clear about what you really favor, what kind of method you really favor. Because the approaches are very, very different. Philosophically, very, very different approaches. In technicals, you don't care about all this fundamental news, why it's going up. Okay, you just care about what's happening to the price and what pattern is being formed, right? So in technicals, what you would do is immediately you would buy here and you would put a stop over here. You see the low high, the highest low from which the new high was made. So here what you would do in technicals is very clear. If you're a trend following trader, the decision is very clear. New high is made, uptrend is established. You would go long here and you would put a stop over here. Okay, as a small, if you wanted to keep a small stop. If you wanted to keep a really wide stop, your stop would be here. So these are the only two real possibilities. Are you following? So you can see that technicals are, in a way, it's much simpler. Your life is much simpler if you're operating from a technical perspective. Okay, that does not mean it'll be more successful or less successful. It could go either way. All right. Okay. So good question that led up to a discussion, and these things are important because later on in life you have to make your own decision, and this is how you will decide. So your decision is going to be based on how do you feel about the market. Like, I mean, what I'm telling you is that the market doesn't react rationally to all, to the same kind of news across periods of time. But don't take my word for it. You have to come out. You can't do your own trading. You can't run your own life based on, what my teacher told me this. You don't accept that. You form your own view. That's why you're given access to these real-time data feeds. You form your own view of what you think the market is like. Okay, and based on that you take that decision. If you feel that the market is largely irrational, okay, doesn't behave rationally, then you would be leaning more towards technicals. And if you are convinced that the market has to come back to rational pricing from time to time, then you would be leaning more towards fundamentals. Are you following that? Okay, so I'm not telling you which way you should go, but I'm telling you basically what is going to drive your decision. And ultimately, the heart of it is your own assessment and your own study of the market and what you conclude about the nature of the market. Yes? Okay. So, where were we? So the reason, we were talking about the stack and roll strategy, right? Okay, I don't know how exactly we went into the I think we were talking about how the price could go up, so you would essentially I've kind of lost the thread as to how we went into the discussion of the chart, but anyway, so I pulled up that crude oil chart and then we talked about this assassination and all that. Okay, so is everyone clear what's going on with the stack and roll strategy? Please replay the video once again and watch it. So essentially what you have to do is that you have total exposure of 240 contracts. Okay, let's just say 240 contracts, and this is going to be your consumption in each of the forward months, and total is 240. But you feel the liquidity in these months is not so good, so what you do is you buy the entire amount for initially for February. Okay, now in February 25 contracts will roll off, you will take physical delivery against the 25 contracts. So you are left with 240 minus 25, which is 215. Okay, so now you're carrying 215 long for March. And remember this transaction that we did, the transaction that you do to roll over into March, this is where the roll part of it comes. The stacking is over here and the rolling comes from here. That in 215 in Feb 25 rolls up, but you still have 215 left, but you can't keep it in Feb because that's expiring. So you roll it into March by doing, you're already long Feb. So you want to have 0 position in Feb and you want to have a long position of 215 in March. So you will sell and buy Feb March. Is this clear? You will sell and buy, very logical, because depending on what you, that's why you need to have clarity about what is your goal. Your goal is to have 0 position in Feb and plus 215 in March. And right now your position in Feb is plus 215. So you have to do a transaction which is sell and buy 215 Feb March. Sell and buy Feb March 215 contracts. Yes, and that is one transaction. Okay, that's one transaction. It's not treated as 2 separate. That's a spread transaction. That's one transaction. This is clear. And we also mentioned, please go back and revise this. We have also mentioned that this is structurally identical to the repo transaction. Please identify, please be clear in your own mind as to why this is structurally identical to the repo transaction. Okay, everyone knows the repo transaction by now. Look at it in terms of base asset, terms asset. Look at it in general terms. In general terms, what we are doing here in this futures intermonth spread, this is called a futures intermonth spread. Okay, so this will be there in your futures contracts note. When you look at I think this note has been put in here. This will be there in your futures note. In any case, if it's not there, I'll put it in. You guys are following what I'm saying here. This is very important to understand. We're going to look at one more transaction where we should understand. This will also cement your understanding of contracts and transactions. Repo transaction, look at it in terms of base asset and terms asset. In a repo transaction, your base asset, think of the base asset as the bond that is used as a collateral. Yes? Are you following? You use the bond as the base asset and think of the currency, let's say you're doing it in US dollars, think of the currency as the terms asset. So bond in a repo transaction, the US dollar markets, the bond is the base asset, the currency is the US dollars is the terms asset, right? In this case, you will replace the bond with crude oil. Okay, you will replace bond with crude oil, or crude oil futures is the base asset. Okay, in this case, crude oil will be the base asset, and again dollars is the terms asset. And you're doing exactly the same thing. In a repo transaction, what are you doing? You're selling and buying the bond in one transaction. Selling for today, selling for near date, and buying for far date. Remember, we used these terms when we did repos. Selling for near date and buying for far date. Okay, that is the borrower's transaction. Same here in the futures intermonth spread, which you are doing in these are all spread transactions. Sell February, buy March, 215 contracts. Sell March, buy April, 155 contracts. Sell April, buy May, 80 contracts. Sell 45, sell 45 and buy 45 in against May and June. Okay, that's another. Sorry, I changed the format of my how I was describing it. But you understand what I'm saying, right? These are all identical. These are all separate futures intermonth spread transactions. Okay, so the futures intermonth spread, we can call this. I'll just write the expression here. You need to use the term very carefully. Always note this is intermonth spread. Inter is not the same as intra, because later on we will also talk about intra-month spreads. Okay, those intra-month is actually inter-month, intra-market. We are going to talk about not intra-month. We are going to talk about inter-market spreads. Okay, so the inter-month, let me also clarify. This is probably already there, but let's make it very clear. Why am I saying inter-month? Inter-month includes the idea of intra-market. Intra, you understand, is within. Okay, so intra varsity means within the university. Okay, inter college means between colleges. Okay, so you can have an intra varsity, inter college. Okay, so here what we're talking about is intra market. Why are we saying intra market? Because all of this is happening in the crude oil futures market. All these spread transactions are being done in the crude oil futures market. We are not going from crude oil into natural gas, okay, or copper. Okay, we are doing crude oil within the crude oil futures market. That's why. And remember, how is the market defined? Two assets. So what is not changing here is base asset crude oil, terms asset US dollars. That market is not changing. Okay, instrument is futures contracts. Okay, so that's why it's intra market, because it's all within the crude oil market. Yes, are you following? But it is inter-month, because I am selling Feb, buying March, selling March, buying April, selling April, buying May. So it is inter-month, intra-market, inter-month. Okay, so please go home and make sure that you understand clearly the complete structural identity of the repo, of the bond repo transaction and the futures inter-month spread. Okay. And the way you will understand that, the way you're going to understand that is see both in general terms. What is the base asset and what is the terms asset? And what is happening in both these transactions is you are selling the base asset or buying the base, either selling buying or buying selling. Okay, so selling buying, if you're selling in the near date, then you're buying on the far date. If you're buying on the near date, then you're selling on the far date. Okay, so in both those cases, I'm just going to use one side as an example. So in this case, in the case of the bond repo, you are selling and buying near date against far date, base asset. Okay, I'm not going to obviously terms asset, opposite stuff is happening. Okay, so I'm just going to talk in terms of, please pay attention and follow. Okay, both the cases you follow. Let me just try and, this is already there in your futures notes. Let me just make sure that we have it. This is very important to understand conceptually. You will not find this in any finance textbook. Okay, so it is important to understand this structural identity, because nobody talks about this. They are discussed as separate transactions, but they are actually, you should understand that they are structurally identical transactions. I think it's in a different note, but I'll put it here. Okay, so what you're doing is generic transaction is buy or sell base terms asset near date versus far date. Has everyone followed the format of my writing? I could be buying the base asset, okay, near date, and therefore selling the base asset far date. I could be you can also talk in terms of terms asset, but generally we talk in terms of the base asset. So if I'm buying the base asset in the near date, obviously I am selling the terms asset in the near date. Yes, so this is the general transaction structure. Once you understand the general structure, then you can apply it to whenever you see a specific kind of, there's going to be another transaction we are going to look at, that is a foreign exchange swap, okay, an FX swap, okay, which is essentially a position maturity altering swap. Again, that transaction will have the identical structure. All these three transactions, which are usually discussed separately, okay, nobody talks about their essential oneness, they're absolutely identical, because their basic structure is this, that I'm going to talk about only about the base asset, just to give you an example, that you are buying and selling the base asset near date against the far date, or selling and buying the base asset near date against far date. Okay, put it in this kind of structure, then you'll see that the transaction is the same. You'll see one transaction with two dates, two settlement dates, near date and far date. So what is happening in the case of the futures? Now can you see this? In the case of the futures inter-month spread, near date, far date. Yes, so I'm selling for near date, buying for far date, base asset. Clear, everyone? Repo is also identical, same thing, because I'm selling the bond in the near date and buying the bond in the far date. Yes, that's how you do borrowing through a repo, right? If I sell the bond, then I will buy the dollars. If I'm buying the dollars, mean I'm getting a loan, right? When you take a loan, money comes into your account. So in the bond near date, what I'm doing is selling the bond, and obviously if I'm selling the bond, then I'm buying the dollars. That means I'm getting the dollars, and in the far date I'll have to pay back the dollars with interest. So I'm selling the dollars, P plus I, and I'm buying back the bond. Yes, So structurally identical, absolutely identical transaction. Okay, this basic structure of this transaction is this, that so we are going to write this as futures. We can just borrow it from here. Where did we have that? Okay, it's in this, right? So this, I'm going to, instead of writing it once again, I'm just going to put it here. Okay, and bond repo, and also let me write FX swap, which we are not going to discuss right now. FX swap. All these three transactions, okay? All these three are identical transactions, structurally identical transactions. This is how it's structured. Buy or sell the base asset or the terms asset, near date versus far date. Okay? And obviously it goes without saying, at different prices. Generally at different prices. Some, because of some peculiar situations in the market, liquidity problems or dislocations, you could have them at the same price, which is essentially zero interest. If I do a repo transaction where the near date and the far date prices are the same, right? That essentially means zero interest. Are you able to follow that? Always see a repo as a secured borrowing transactions. So if I have, now because of market dislocations, as you know, now in Europe we have negative interest rates, in Japan we have negative interest rates, the Scandinavians also had negative interest rates, right? So, but in general you do not expect negative interest rates. But if you are able to do a bond repo where the near date price on the bond and the far date price on the bond are the same, that means you're borrowing at zero interest. Are you following? Yes? Because your P plus I is equal to P. P is what you got on the near date by selling the bond, and then at the far date, on the far date you have to pay back P plus I, but you find that P plus I is equal to P, which means I is equal to 0, right? So you can have that when the market dislocations, but generally we don't expect that. So that's why you notice initially I wrote at different prices, but then I qualified it to write generally at different prices, because it's not always true. Sometimes you can have them at the same price. Okay, so this is basically what it is. Okay, so it's very important to understand this transaction. Okay, so is everyone clear now about this stack and roll? And this is why we said that the decision with respect to the maturity. The decision with respect to which expiry date to use in the case of hedging with futures contracts. The decision is actively solved, okay, because you have the possibility of doing a stack and roll instead of buying specifically against the expiration dates, right? So that's why it's actively solved. Okay, next, entry price. Next decision problem is entry price. So we saw that buy sell, the buy sell decision per se is automatically solved. What about entry price? If we go back to our, let's say we are hedging and we are going to make, for the moment we're going to make an assumption that people with jet fuel exposures are directly hedging in the crude oil market, because there isn't a very active jet fuel market, not as active as crude oil and not as liquid as crude oil. So we're going to assume that the airlines are hedging, or we can make the simplifying assumption that they actually have to buy crude oil and put it into the aircraft. Okay, so their exposure, they're short crude oil and they're hedging in the crude oil futures markets, right? So what's our decision problem? Okay, so what we saw is that their bias as to buy or sell, this kind of bias, that is automatically decided, because if they're jet fuel, if they're airlines, that means what is their underlying position with respect to crude oil? Long or short? Yes, Surbi? If I'm an airline, what is my underlying position with respect to crude oil? Short. Why? One minute, be quiet, let her answer.
Because we'll buy when the prices of the oil will be decreased,
will be going down. No, but that's not the reason. No, why? If you want to answer why your underlying position is short, what is the logic that I've taught you? How do you justify that your assessment about somebody's underlying position being short is correct?
That when we sell
when you sell, what happens?
when we sell the price, we sell when the prices goes up.
No. This is not the right way to explain. Yes, SG1? Is my question clear? Her answer is correct, that in the case of an airline, their crude oil, their exposure, we are just mixing, we are treating jet fuel and crude oil as the same. In the case of an airline, their exposure, underlying exposure with underlying position with respect to crude oil is short. But her justification is not correct. What is the logic I've taught you? It's very simple logic. We can see that Srishti also doesn't know the answer because you don't know the answer. Okay. See, these are very simple, these are very logical things which I've taught you. Now you don't even remember all this. What is the simplest answer to how do you figure out that a person's underlying position is short? Okay, you also are not clear. Okay, so yes, Verma, you know, right? How do you justify that the underlying position is short? Surbhi is correct. Surbhi is correct that the underlying position of an airline is short with respect to crude oil. But how do you justify her answer?
So if my underlying position is short, then I must have assumed the market is about to drop.
No. Yes, Mehak. You give her the mic. Give her the mic. Is my question clear? You know what kind of answer, what I'm looking for. I'm looking for a clear-cut justification of Surbhi's answer. It's not working. Okay. Okay. Yeah. Yes.
Short position because if the market goes up, then we lose money, and if the market goes down, then we'll earn money.
Okay.
So similarly,
Okay. That's fine. So that is the right way to justify, right? That you know that in the case of an airline, given the kind of profile that they have, their position has to be short because when crude oil prices rise, they are losing money. And when so you were going to finish the second part, I stopped you there. And the second part, and when crude oil prices fall, they are making money. Is that clear? Everyone agrees with that? And then you ask yourself, the second part of the answer is, and what kind of question, what kind of position has that kind of behavior? That when the market goes up, you make money. When the market goes up, you lose money, and when the market goes down, you make money. And the answer is that has to be a short position because a long position doesn't behave like that. Is this clear? Are you following? So it's a two-step logic. That's what you were going to say second, right? Is everyone clear about this? This is very basic stuff. Okay, this is very basic stuff, but once you understand the logic, you'll never forget it. Yes, Khushbu, is it clear?
I feel it should be long.
No, but what happens if, so always go back to the airline's exposure. What do you think about an airline? If crude oil prices go up, is it good for the airline or bad for the airline? It's bad for the airline. So you can equate that to losing money. They'll actually be losing money because if they can't change ticket prices, you get these fuel surcharges and all that. That's because our market is not that competitive. Okay, so these guys cartelize and they sort of convince the regulator to allow that. But fuel surcharges, if it's a very competitive market, remember what did you see in price competition, in perfect competition? That you're a price taker, you can't set prices. Okay, so therefore, but your costs are going up. 50% of the operating cost is crude oil expense. Okay, so your costs are going up, but you can't change your prices, right? So what is happening to your margins? They're going down. So it's like losing money. You may not actually be losing money on an absolute basis, but it's the equivalent of losing money. Yes, everyone agrees. And when crude oil prices go down in a symmetrical way, then you're making money.
Yes, sir.
Okay, so that's how you should find out the answer to these questions. So you need to know the context. Obviously, if I ask you what is Norway's underlying position with respect to crude oil, you need to know that Norway is a big exporter of crude oil, right? So then you figure out, okay, if this is a big exporter, then what will happen to their P&L if crude oil prices drop, and what will happen to their P&L if crude oil. So this is how you have to figure it out. That you have to figure out what happens to their P&L if the market goes up and if the market goes down. And then in this case of the airline, you find that when the market goes up, they lose money. When the market goes down, they'll make money. And then you say, okay, what kind of position behaves in that manner? Is it a long position or a short position? And then you can figure out that it's only the short position that behaves like that. Yes? So this is the logic. So you can see how basic, this is very basic stuff. Okay, and everybody's not clear about it. So you can see why I take the phones away. Right? Okay. Alright, now where were we? Yeah. So the reason I went into we can see with this recap that people are not clear about basic stuff which has already been discussed. But the point I was trying to establish is that once you, as far as the buy-sell bias is concerned for a hedging team, once you know your underlying position, the buy-sell decision problem is automatically solved. Is everyone clear about that? Because in hedging you have to reduce risk. And if we take this, we take a purest example of a static hedging program. That means every transaction you do has to progressively reduce risk, right? In a static hedging program, and that's consistent with the philosophy of hedging. All right. So now, therefore, you know that for when your underlying position is long, as far as the buy-sell decision is concerned, it has to be sell. You have, so it is automatically determined. But now my question is, what about the entry price? Entry price decision problem, because let's say look at it, if I'm hedging crude oil for Ryanair, okay, if I'm on the hedging team and I see crude oil prices are shooting up, okay, now I have to take a view at some point. I know that I have to sell, I know that I have to buy because my underlying position is short, okay, I have to buy. Now the question is, when do I buy? Do I, now that this thing has come with all this very scary fundamental news has come out, the price is also behaving in a scary manner, the price is shooting up, making new highs. Should I buy it now? If I buy it now immediately, this is now the question of entry price. Am I going to enter at market? Am I going to enter with a limit order? Remember, go back to the same way of solving these problems. Entering with a limit order or a stop order or a market order. Yes? Yes. This is clear? So the same problem I have now even as a member of a hedging team. Should I enter with a market order? If I'm entering with a market order, that means my view is that this stuff is going to shoot up right away. I'm not going to get a chance to buy it at a slightly lower price or anything. Okay, like what happened here, it shot up initially and then it came all the way, slowly sliding down. This is not going to happen. This is going to shoot up all the way above 68, 70, 72, whatever. If I hedge at market, if I buy right now, okay, should I enter at the market price or at a less favorable price or a more favorable price? That decision has to be taken, right? Is everyone clear? So if I buy at market, that's my view. If I wait, if I don't buy it now, I know I have to buy it, but I don't buy it now because I feel that whatever happened here, the same thing is going to happen. It's just going to shoot up initially in a panic reaction and then it will start declining like this. It will start slipping down and then I'll get a better chance to buy maybe around 56 or 57 or something, right? So if I think I can buy at 57, why should I buy at 63, right? Is this clear? So now coming back to the question, or otherwise the other thing that I could do to discuss the full range of options once again. First is the market order. If I'm afraid that it's going to shoot up right away, significantly higher, then I should use a market order and enter the market right now. Okay, that is buy right now. If I feel that this particular rally is going to be short-lived and it's going to come down later on and then I'll get a chance to buy at a lower, then I'll use a limit order. Yes? Okay, recapping all your previous concepts. But if I feel that, the other thing is that I feel that there's no real big risk on the oil price unless it goes above this high, which is here, which seems to be around 67, let's say 67. Okay, so unless it goes above 67, if I feel that now the mic is already conked out. Yeah, okay, we can use the hand mic. Let's try and, yeah. Okay. All right. So once again, we are recapping those concepts. So please be clear if you've forgotten your active risk book concepts. The concepts do not change. As far as the entry price is concerned, okay, once you've made your buy-sell decision and all that, the entry price is concerned, you go back to the same framework. At the market, at current market prices, then you use a market order. At a price more favorable than the current market, then you use a limit order. And it's less, if it's less favorable than the current market, then you use a stop order. Okay, same framework applies. So here, even the hedging team could use a stop order because they might have and it all depends on your market views. So the hedging team might have a view that, okay, this particular blip in the price we are not really concerned about because we feel that unless the price clears 67, there's no significant risk of upside in oil prices. That could be your view. In this case, what kind of order will you use to buy? Yes? In this case, it will be a stop order. Because what are you saying? You're saying if the real significant risk of upside in oil prices comes if the price goes above 67, right? So if there is if 67 is broken, then there's a risk of a very sharp rally in oil prices, maybe to 70, 80, 100, 80, 100, etc. So at that time you want to be fully covered. That means you want to be fully hedged. Okay, so you want to buy your entire exposure at that time. So if the market right now is at 63 and you really want to buy only if the market goes to 67, right? So 67 is from a buyer's perspective, 67 is less favorable or more favorable than 63. Less favorable, right? So you are planning to buy at a less favorable price, less favorable than the current market. So which kind of order are you going to use? Stop order, right? So you'll have a buy stop for whatever 240 contracts, whatever that exposure is. You'll have a 240 contract buy stop order at 67. Is this clear? We are recapping all our methods from before. Okay, you can see that there's a lot of similarity as well. There's a lot of similarity between active risk books and passive risk books, but it's not identical. There are some important differences. Okay, and this is another reason why I have taught you the general decision problems, because there are a lot of similarities between the two. In most MBA programs, you'll see risk management is handled as a separate silo, as a separate category of courses. Okay, it's a separate course, but actually that's why I teach it as a continuum, because many of the principles are the same. You can just see some small differences. Okay, all right, so we go back to our so is everyone clear now that the entry price decision is, as Tarun pointed out, is actively solved? Yes, because the hedging team has the option. The hedging team is looking at the situation. They know that it's an airline, they're short crude oil, the underlying position is short crude oil, so they have to buy. But the entry price, so they have to go long. As far as the buy-sell decision is concerned, the answer is buy. But the entry price decision has to be actively solved, because even if they are going to be buying, there's still a decision to be taken as to should we buy right now at the current market, should we buy at a price less favorable than the current market using a stop order, or more favorable than the current market using a limit order. Is this clear? Is everyone clear about this? Why there's a difference? That buy-sell SG1 is not clear. What is not clear? That buy-sell part is automatic. That is clear. Yes. Because if you're an airline, your underlying position is short, so your hedge transaction has to be a sale. Your hedge position that you create has to be a short position, because in hedging you have to reduce your risk. Okay, we are going to have most of our discussion with respect to static hedging program, because that is a classical form of hedging. Okay, so that is clear. You have to be a seller. And if your underlying position is long, in this case your underlying position is short, you have to be a buyer. But buyer still leaves you the question, even though you know you have to buy, you still have an option. Do you have to buy right now, or do you want to wait and you think it's going to come down a little bit low, it'll come down a little bit, you'll get a more favorable price? Or are you not at all worried about this? You are only concerned if it goes above 67. So you still have to take that decision. Okay, I think it becomes a little clearer. I think some other people maybe also, because this again you will not see this kind of a discussion in a fundamental based course. Now once you look at this, it becomes a little clearer. We are looking at crude oil. See, this situation that the buy-sell decision problem is automatically solved. Okay. However, the entry price decision problem is not automatically solved. So the buy-sell decision problem is automatically solved, but the entry price decision problem is not automatically solved. That distinction becomes much clearer once you start looking at the market in multiple time frames. Remember, I've told you to look at it in multiple time frames. So you have a long-term trend, medium-term trend, short-term trend, etc. Right? So maybe let's say that the hedging team is operating. The main decision problems, the main decisions are being taken with respect to the long-term trend. Okay. So if you look at this example, so I'll just give you an example. That if you look at something like this. Okay, so if you look at this, let's say this particular chart, this is the weekly chart. Okay, here you can see the same level that I pointed out, this 67 level. Okay, this same level, this one is the same as this thing here. All right, so You remember you remember when I told you about operating, when you're taking views on markets, you look at, because you can actually have charts with different data ranges, right? These are all, what is the difference between these charts? They're all, the market is the same, but the data range keeps getting smaller as you move like this. As you keep moving from here to here, the data range keeps getting smaller, and the last value is always the current market price. Are you following the structure of these charts? We have discussed this before. Okay, so this is a common way of looking at markets, especially if you're operating with a technical perspective. Okay, this is and even if you're not operating from a technical perspective, you should still look at it this way, because then you can see the different degrees of trend and where the market is. Because remember, this data is all objective. It's 100% objective data, so that's useful to look at even if you're not a technical analyst. So what is happening in these charts, you have the same market, the end point is always the same, but the data range keeps getting smaller as you move from here to here and then down. Okay, the data range keeps getting smaller. Are you following? So which means it's as if you're zooming in, right? It's just like it's progressively zooming in to the price action, right? That kind of view. So you could have, the hedging team might have formed its view about the risk of significant upside by looking at this degree of chart. They're looking at this degree of chart, okay? And here they feel that as soon as this, because they're looking at this low, so one higher low, and then they have a high here, or you can look at this, you can zoom into this part here. You can see this part is zoomed in over here. So they may have looked at this and said, okay, this is a low here, this is a second low here, and then this is the first high after this low, and then if it goes above this, then there'll be a second high. Are you following? Okay, so then there'll be two highs, a higher highs, you have higher highs and higher lows, right? So the hedging team might have looked at this degree of movement and decided that if it goes above 67, only then do we have a risk. Okay, and so what they do is they're also looking at the short-term movement, and they look at this kind of then they look at the detail of this move, okay, and then they feel that this thing is not going to go straight up and break above 67. It's now likely to come back. They can look at this particular movement and take a view that this will actually come back to around 57 or so before it eventually goes above 67. Before it eventually goes above. This is based on your view. You don't have to always do it that way, but I'm just trying, what we are pointing out is possibilities, okay? Remember, the reason we said that the futures expiration date, the choice of expiration date is actively solved, the reason we said that is because there is a chance that it might be actively solved. There is a chance that you might actually do a stack and roll hedge. Are you following what I'm saying? If at any point you don't follow what I'm saying, because I may speak in long complicated sentences, because I want to make sure that whatever I'm saying is very clear and is actually correct, and small changes like that generally at the same price, all those things, I'm very particular about what I'm saying. So it may seem very complicated. If you don't understand, please ask. Okay, so what they might do, so there is a possibility that they may actually take this view that this is the real risk point, and this particular movement now is not going to sustain. It's not going to go straight above 67, but in fact it will come down to around 56 or so before it might start to move up. Are you following? This is all a view that you have to take about the markets. Remember that's why I told you that everything you do in a finance role is going to be based eventually on taking views on markets. Whether you're raising equity capital or raising debt capital, everything is based on market timing. Okay, what kind of performance you can show is going to be based on your ability to time the markets, right? So therefore you have to take a view on the market. So they may take this view. So because the possibility exists that they may take this view, that's why you have to treat this decision problem as actively solved. Okay, they could also just simplify their life and say that whatever we decide to do, buy or sell, we are just going to do everything at market. Okay, that means that is a decision you can take, but the point is you do have the choice to use either a stop order or a limit order or a market order. You do have the choice, but you could also decide to do it everything at market. In this case, the decision problem, but you're still decision problem of let me just go back to that listing here. Yeah, so the entry price decision problem is still being actively solved, even for somebody who says that I'm only going to use market orders. So once I decide that, you can even have it built into your risk management policy, that once you decide that you have to buy and sell, or buy or sell, and that is very clear from the underlying positions, which means this becomes a situation where a company, if you decide that your entry price decision is always going to be using a market order, that means it's a company which immediately hedges everything. Are you following? Because you already know your underlying position based on what business you're doing. So let's say Infosys signs a big contract with, let's say, ExxonMobil in the US, and let's say it's a $50 million contract, and then the money comes in. The moment they sign the contract, they know the money is coming, $50 million is coming after 1 year, right? That means the exposure the underlying position has been created. Once the contract is signed, okay, they know that after 1 year they're going to receive $50 million. Yes. So their Infosys balance P&L statement, financial statements are in rupees, right? So in this particular case, what is Infosys's underlying position now with respect to the dollar rupee? What is happening, Shuchi and Parul and all? You're right, doing knots and crosses on some combined board. Okay, look, just sit straight. Okay, sit straight and look. Shuchi seems to be concentrating on Parul's sheet.
Actually, I have been last class over that.
Okay. All right. Okay, fine, no problem. Okay. All right. Okay. So let's do a quick recap.
Short.
Yes, let's ask Parul, since she has the notes. Okay, in this particular case, Infosys, let's say that Infosys has a policy of entry price is always going to be solved as market price. We are not going to use stop orders or limit orders. As soon as the exposure arises, we will hedge. The entry prices, decision of entry price will always be decided. The decision problem will always be decided or solved by choosing to execute at the current market price. Okay. Now, this example of a contract, they get a contract from ExxonMobil where after 1 year they'll be receiving $50 million. Their balance sheet currency is rupees. Okay. So now my question is, as soon as the contract is signed, the exposure arises. Clear? Are you clear about that? Contract is signed. Ordinarily, you expect contracts to be honored. Okay. So therefore, the exposure has now come into being. So now my question is, at this point, what is Infosys's underlying position with respect to dollar rupee, the dollar rupee FX rate? Is my question clear? Once the contract is signed and the exposure is clear. Okay. What is their underlying position with respect to dollar rupee? Is it long or short? They are going to receive $50 million from ExxonMobil because of the contract after 1 year. Is everyone clear about the contract? Please think, because later on I'm coming to ask Srishti, Sukriti, questions will be asked. Please think about the answer. Is the question clear to everyone? As soon as you sign the contract, the exposure arises, and we haven't even come to the second part. My first question is then, what is your exposure? If you're Infosys, what is your exposure with respect to dollar rupee? No, we talk about it as dollar rupee because when you talk about the international markets or the standard way of trading dollar rupee, okay, just like the standard way of trading cable is with sterling as the base currency. But the standard way of trading dollar rupee, just like dollar Swiss, dollar Canada, okay, is with dollar as the base currency. So when we talk about the USD INR exchange rate, we talk about the dollar, we call it dollar rupee, okay, not rupee dollar. But mathematically you can say there's no difference. Right, so let's look at this as a long-term chart. Right, so yes, Parul, now imagine, how do you, when you get a question like this, how do you answer the question? You immediately ask yourself, what happens to the entity if the market goes up? Because we are discussing, what are we discussing always? The general framework of the question is, what is an entity's underlying position with respect to a particular market, right? That is the general framework of the question, right? So entity here is Infosys and the market is dollar rupee. I pulled out a dollar rupee chart for you to help you to make the decision. Now what question are you supposed to ask yourself? Quiet.
If the price goes up,
Quiet, be quiet. Yeah, if the price goes up,
whether we make the money or not.
whether we make money or not, and if the price goes down, what happens when we make money or not? Okay, now answer that question for yourself.
There will be contract.
Let's say the dollar rupee goes up. What happens? Is it good for Infosys or bad?
If they will make money.
Be quiet, be quiet.
If the dollar rupee money goes up,
Dollar rupee, not money. If the dollar rupee rate goes up or the dollar rupee goes up, just say dollar rupee goes up because that's a market. Yeah. If the dollar rupee goes up, it's good for Infosys.
yes sir.
Why?
Because they will
Be quiet here, guys. Be quiet. I want to hear a detailed answer. Huh?
because they will make money.
How will they make money? How will it make money? Can you spell it out? Even though I'm like a computer, I don't understand your logic. Can you explain it clearly?
If the
1 minute.
if the price goes up, they will make money because the value of the dollar is rising.
Okay, good. So, even more precise way of saying it, what she's already said it, that the value of the dollar is rising, which means each dollar is going to buy more and more rupees. Okay, now you may think this is very so simple, it's almost idiotic, but this is how you should teach yourself how to think so that you explain it. You're always thinking of how you explain it to a computer. This forces your logic to be very clear because computers don't understand anything. You have to explain everything to them in mathematical terms. That each dollar is now buying more rupees. Okay, so when they sell that dollar, they'll make more rupees in their balance sheet currency. Yes? Okay, so Parul has established that Infosys is long dollar rupee. Now, if Infosys has a hedging policy, okay, if Infosys has a hedging policy which requires the hedging team as far as the entry price, because when you have a hedging policy for a company, you'll have to address all these decision problems. What is the hedging policy document? That is a document which formalizes the answers to each of these questions. What should we do about entry price? How should we solve futures expiration dates? All these answers are formalized, and then the hedging team has to follow those guidelines. Are you following what I'm saying? Right? So if the Infosys hedging policy document says that as far as the decision of the entry price is concerned, it is always to be solved by choosing a market order. Okay, that means the exposure is to be immediately hedged at the current market prices. That is a choice they have as a company. They could leave it to the discretion of the hedging team. Then okay guys, you can use based on your judgment about the market, you can use a market order, limit order, stop order, based on your view on the market. Okay, view of the market. A very conservative company could also decide to say no discretion. As soon as the exposure arises, you know the buy sell side. You have to the entry price decision has to be solved by using a market order, which means you have to hedge immediately at market. So if that is the case, then in this particular case, Infosys will the hedging team will, as soon as the exposure arises, they will immediately have to sell or buy dollars, forward dollars. Yes. Now, Srishti, you can tell us what will they do if the hedging policy requires immediate hedging at market prices. So in this case, what will they do? What will be the hedge transaction? Is my question clear? Because Parul has established the underlying position. Okay, now related to that is the concept of hedge transaction and hedge position. Remember that? Be careful about all these terms. Hedge transaction is sale or purchase. Hedge position is short or long. So hedge transaction, what will be the hedge transaction in this case? Sell. Okay? Is this clear to everyone? In this case, so remember that actually the entry price decision is actively solved because if in general you will have the discretion to use any type of order, but if a company locks in its hedging team to forces them to hedge using market orders, it means that as soon as the exposure arises, everything is hedged 100%. This is clear. This is the most, it's also useful to understand this approach because it gives you the most conservative benchmark for hedging. This is as conservative as it gets. So this company does not carry any risk. As soon as the exposure arises, everything is hedged 100%. Okay, nothing wrong with that. That's also a policy, and this you can understand that this is like one side. You understand one like one extreme end of the spectrum, like a pure vegetarian. Okay, doesn't eat eggs or doesn't eat other kinds of even marginal products. Okay, so that's an example of one kind of approach. So you get one extreme approach, which you can see as a benchmark. Okay, is everyone clear about this now? Entry price, right, actively solved. Exit price again will be split into what will happen with the exit price. Let's assume that in this case of market order, if we assume that this thing is solved using a market order, this becomes more complicated to discuss because it's not complicated in itself, but there will be many scenarios. So we take one scenario, that assuming that the market order is used to hedge. Okay, in the case of an exit price, what will happen? Exit price with loss. And if we discuss it, because remember this discussion now can give rise to many scenarios, depending on whether you're using a static program or a dynamic hedging program. Is this clear? Okay, but we are going to discuss it only with respect to a static program to keep our life simple, so that you understand. And further, we're going to further simplify it by making the assumption that the previous decision problem with respect to entry price has been solved using a market order. In this case, in this particular case, which is only one of the possible scenarios, where in this case what happens to this? If you are running a static hedging program and you have hedged everything, the entry price is solved by choosing a market order, so the position is the exposure is hedged immediately. Is there any decision to be taken with respect to exit price? Exit price with loss. Let's start with exit price with loss. Is my question clear? If you are running a static hedging program, okay, and if you are also if you have also got a policy of using market orders with respect to the entry price, which means essentially that as soon as the exposure arises, it is hedged 100%. Right? That's what we saw in the case of Infosys. 100% hedging instantaneously as soon as the exposure arises. In this case, having done this, is there any further decision to be taken with respect to exit price with loss? Yes? So Tarun is correct, there is no decision to be taken because you're running a static hedging program. Are you following? You're running a static hedging program, so there's nothing else to be done, because what is the characteristic of a static hedging program? Yeah, so once you hedge, you never unhedge. You never unhedge whatever part of the exposure you have hedged. And in this case, we have talked about market order. In the previous decision, we have taken an extreme case of a very conservative company which hedges everything 100% as soon as the exposure arises. As soon as the exposure arises, they hedge everything 100%. And they're also running a static hedging program. So therefore, it follows that there is no decision to be taken with respect to exit price with loss once you have hedged it. So here actually a hedging team has no real, in this kind of example of where we are forcing the entry price to be decided in favor of a market order, here you really don't need very sophisticated analytics in the hedging team, because it's almost automatic. Okay, you just need to be able to figure out which way the underlying position is. That will tell you which way the hedge transaction is, as Srishti pointed out. Okay, based on the underlying position information from Parul. Then this if it's an underlying position is long, then the hedge transaction has to be a sale. Okay, so that in this kind of a extreme example, you should be able to see this also as a benchmark of a pure example of an extremely conservative hedging approach, where there is basically, in this kind of a situation, you don't need very sophisticated market analytics and the hedging team, because they're not going to be taking a view on the market, right? There's nothing to take, no view to take, no market view to be taken, because all you need to know is to be able to figure out the logic of what your underlying position is, and then you know immediately that you have to do the opposite and in the hedge portfolio, and the rule says that you have to do it at market prices. Your company's risk management policy requires that you have to hedge. The entry price decision has to be solved by choosing market orders, and 100% hedging with market orders, and therefore that's it basically. You don't need to do any, you don't need to take a view on the market. Yes, are you clear? Okay, but in fact, of course, most companies don't operate like this. Maybe a few of them do, but most companies don't operate like this. They use some discretion in when to hedge, how much to hedge. Okay, so that's why I say that in most finance roles that you will actually take up in industry, you will be required to take some kind of view on the market, because that's what most companies do. But it's useful to have the pure idea of the extremely conservative approach to hedging, which is 100% hedging as soon as the exposure arises, which means essentially in terms of this, that the entry price is decided by problem is solved by choosing market orders. Yes.
Yes, sir.
No, we still have 4 minutes. Okay. So is this point clear, that if you are taking a pure example, we are only going to discuss a few scenarios, because otherwise we'll have to go into so many scenarios, because we can look at depending on whether it was using a Tedos limit order, stop order, static hedging program, passive hedging program. So we're not going to do all that, but we're just taking this pure example of a very conservative approach. So in the same case, static hedging program, is there any decision to be static hedging program with entry price solved by choosing market orders? Is there any decision to be taken in terms of exit price with profit? Is there a decision problem here? I mean, is this decision problem, it's there, but is it automatically solved, or does it need to be actively solved? When you have a static hedging program, automatically solved, because again, static hedging program, whether your hedge is making a profit or a loss, you can't do anything to it. You can't touch it, right? So it is automatically solved. Are you able to see this? What we mean by automatically solved? Okay, so you're able to see also the connection between. The reason I'm using the same list is that you're able to see the connection between an active risk book and a passive risk book, and how there are some small differences in terms of decision problems, which ones get automatically solved and which ones have to be actively solved. Yes? Okay. 1 minute. So we do have, in fact, we have 2 minutes. Okay. So exit. What is the other one? Any other decision problems left? Okay. This is because since we have copied it from the active risk book framework, right? When it comes to exit price with profit, there are additional decision problems with respect to the initial exit price, and then we talked about pyramiding and all that. Remember, we had all these calculations. If you want to add to your position, those problems arise. Okay, so we will not discuss these further for this, because again it will complicate the scenarios. But I think you get the flavor of what is happening with each of these decision problems. Are you able to understand what is going on? That some of these decision problems which arise in active risk books, when it comes to passive risk books, some get automatically solved because of the fact that it's a passive risk book, yes, against which you're running a hedge portfolio, right? And some have to be actively solved. Everyone clear? Please make sure you revise. Okay, those who are looking blank must make sure that they revise. Okay, your class is dismissed. So today I've given you a minute extra to make up for all the time. I gave you 20 seconds extra.